Hello everyone, thank you for tuning in. This is a part of a series of webcasts prepared exclusively by Corporate Citizenship for Bursa Sustain, the website set up by Bursa Malaysia to provide resources for Malaysian public listed companies to help them on their sustainability journey. My name is Priya, a sustainable finance advisor for Corporate Citizenship, and I will be walking you through this webcast to help you understand the key differences and overlaps between Islamic finance and sustainable or green finance. In this session, we will be taking a look at the landscape for each, the Islamic finance market, as well as the global sustainable finance market. Following that, I will walk you through some case studies in Malaysia which represent different financing opportunities and outcomes. By the end of this webcast, you should be able to understand the salient features of Islamic finance, sustainable finance, and where they intersect. Islamic sustainable finance. Islamic finance is a broad category of a variety of financial products which are deemed compliant under Sharia, Islamic law. Conventional financial products can include features which do not adhere to the principles of Islamic law or are considered haram business activities. Key features or prohibitions include earning interest, profiting in the absence of the ownership of assets, gambling, or speculation are often features of mainstream financial products, including bonds, funds, derivatives, and futures. Islamic finance principles are designed for Muslims to invest in savings and raise finance outside of these conventional financial products. At its core, the principles are Maqasid al-Sharia, which means the belief that it is our human responsibility to work for the greater good of all creatures, humans, and future generations. Indeed, Islamic finance promotes sustainable development through its principles of fairness, equality, and ethics. In the last decade, the market for Islamic finance has evolved significantly across Southeast Asia and the Middle East. Today, the capital markets regulations and tax incentives, particularly in Malaysia, have built up investor confidence. For investors, Islamic finance provides a stable and Sharia-compliant source of income. Malaysia plays a significant role in global Islamic capital markets, representing over 34% of Islamic funds globally, and is the leading single country with the greatest volume of Sharia-compliant assets and the highest number of banks providing Islamic finance products. However, the MENA or Middle East North Africa region, which includes the GCC Gulf Cooperation Council countries, have a combined share of over $1.4 trillion. Interestingly, in this chart, you can see the steady rise in Sharia-compliant assets across the Middle East and Asia since 2010, but a more inconsistent trend across Western nations. According to the Islamic Finance Development Report in 2020, the global Islamic finance market is now close to $3 trillion in value and is expected to reach $3.69 trillion in the next 3 years. The examples I show you today will be fixed income debt products. Put simply, in conventional financial markets, companies issue bonds to investors in exchange for cash to help develop their business with the intention of paying back bondholders the amount borrowed plus interest. In Islamic finance, a type of fixed income debt instrument is called a Sukuk, which enables companies to raise money to develop their business. It is structured in a way to pay back to investors or Sukuk holders a pre-agreed amount plus a share of profits which are tied to the ownership of assets of the company, not interest. It operates entirely in line with the principles we discussed earlier on slide 4. As you can see from the chart, the market size of Sukuk has grown fivefold in the last 10 years, and COVID-19 actually accelerated the demand and issuances of Sukuk products. Okay, time for our first case study. Here we have a purely Islamic finance deal. In October 2020, Bermas Auto Berhad, a distributor of Mazda vehicles and spare parts, raised 500 million ringgit through a Sukuk Wakala product. This was to help refinance existing financial obligations and finance working capital requirements, capital expenditure, and for general corporate purposes. In this case, the Sukuk received a good credit rating of P1 and AA3 from a Malaysian ratings agency, who determined the company had a strong capacity to meet financial obligations. Over time, investors of the Sukuk will participate in the appreciation of the value of Bermas Auto Berhad and its assets. In fact, Muslim investors regard a Sukuk as a superior asset class to traditional bonds. In general, they have produced stable, long-term returns with lower volatility and higher yields relative to comparable fixed income securities. In the case study we just reviewed, there is no green or sustainable aspect to the financing. What does that mean? Sustainable finance refers to the allocation of capital and investment in favor of activities and projects which promote sustainable long-term environmental E, social S, and governance G goals. Together, these are often referred to as ESG investing or ESG risks or responsible investing. Green finance is a focus on environmental goals which are often climate-centric, involving the decarbonization or reduction of greenhouse gases generated by the economy's products and processes. Social projects can often work to alleviate employee well-being, labor rights, lead to poverty alleviation, or address issues communities face by COVID-19. The scope of sustainable finance is far-reaching and has permeated multiple financial products, listed and private. They can be directed to single or multiple projects, could be highly localized or consolidated in a global fund, and indeed can be integrated with Islamic finance products. As global investors and regulators proactively work towards ensuring financial assets and products are sustainable, a number of commitments, frameworks, and standards have emerged. In 2015, a landmark conference called the Conference of Parties, COP for short, was held in Paris. This launched the Paris Agreement, where countries all made national commitments to materially reduce carbon emissions. Also in 2015, the United Nations released the Sustainable Development Goals, SDGs for short. These are 17 goals that address important issues ranging from poverty elimination, protecting life below water, to responsible consumption and production. The combination of these two commitments have accelerated various product and market standards, which help to ensure impact and avoid greenwashing, a term commonly used to express the financing for projects which don't result in meaningful ESG outcomes, or indeed a lack of action in line with stated sustainability commitments. In our next case study, you will hear about green bonds, social bonds, and sustainability bond principles. These are widely used, internationally recognized principles which help determine whether or not a bond can be labeled as green, social, or sustainable. This labeling helps investors assess whether the product they are buying is in line with their sustainable investment approach. The global green finance market is growing. ASEAN presents a $1 trillion opportunity in green finance over the next few years, which is comparable to the global green debt market, which has exceeded $1 trillion already, of which ASEAN green debt market has much potential at about 800 billion US dollars. In Malaysia alone, the green finance market is estimated to be over 1.3 billion US dollars. Malaysia has acknowledged the concern for climate risk and the need to decarbonize. Being a member of the Network for Greening Financial Services, Malaysia is plugged in to the global financial regulators community, working to assess the impact of climate risk on financial stability. Malaysia has included in its transition to a low-carbon economy under the 2021 to 2025 12th Malaysia Plan, and has implemented several schemes to incentivize companies to transition to more sustainable business practices, including the Sustainable and Responsible Investment Sukuk and Bond Grant Scheme, Green Investment Tax Allowances, and green income tax exemptions. Indeed, over 75% of Malaysia's green finance is directed to green energy initiatives across green buildings, solar, and quite notably, hydroelectric projects. Given the growing domestic and international demand, green Sukuk can potentially open up opportunities in transport, water treatment, and waste management projects. Time for a second case study, a sustainable finance deal with no Islamic element to it. Agroto Business is an integrated farming operator in Perak. They want to improve their business practices and fresh farm produce to be more sustainable and need long-term financing to do so. They chose to issue an ASEAN sustainability bond. Although their business activities are permissible under Islamic law, this bond pays interest to bondholders and is not Sharia compliant. The ASEAN bond standards require Agroto to meet both ASEAN Green Bond and Social Bond published principles. It also requires them to specify targets which are meaningful, ambitious, and helps improve the overall sustainability profile of the company. A second-party opinion provider was appointed to verify and validate the appropriate alignment of a grotto's bond with these internationally recognized standards. Adhering to these standards makes the bond much more attractive to responsible investors around the world who are looking for opportunities to invest in labeled projects with green outcomes. For this deal, a grotto chose to link their targets to 6 United Nations Sustainable Development Goals, which the 300 million ringgit bond financing will assist, including, for example, the improvement of sustainable food supply, higher levels of economic productivity through innovation, protecting labor rights, and the environmentally sound management of waste and chemicals. Now we come to the last case studies. Both are deemed Islamic and sustainable under the relevant frameworks. Firstly, to your left, we will look at a green renewable energy case. Sinar Kamiri raised 306 million ringgit through a green Sukuk to construct a 49 megawatt solar photovoltaic power plant in the state of Perak. It is expected that this solar plant will save about 50,000 tons of carbon dioxide and contribute to 4% of Malaysia's total solar capacity. The financing was structured as a green Sukuk, in line with the Malaysian Securities Commission Sustainable and Responsible Investment Sukuk Framework and Green Principles, which require that proceeds are put toward investment in green projects. In this case, the investment in renewable energy is clear. Now, moving to the right of the page, and the final example I have to share with you today, is a socially aligned financing in response to challenges faced by COVID-19. Malaysia issued a sovereign Sukuk raising 500 million ringgit to improve rural telecommunications networks with the goal of enabling student access to online education during the pandemic. Again, this is in line with the Sustainable and Responsible Investment Sukuk framework, with the addition of clear social objectives of digital inclusion and education. In both cases, the product is not only attractive to Muslim investors who look for Sharia-compliant securities, but also to non-faith-based responsible investors. Indeed, the outcomes for both projects yield long-term benefits for the country's future development and resiliency. To summarize, there are clear differences in features and investment outcomes for Islamic finance and sustainable finance, respectively. There exists a natural nexus between the two, building upon the concept of Maqasid al-Sharia. Islamic products must be approved by an Islamic finance framework or Islamic scholar, and they will be Sharia compliant. There are a variety of structures and products, but they're typically targeted to Muslim investors. Sustainable products will need to follow relevant green, social, or sustainability principles and targets, and are propped up by corresponding reporting standards and second-party opinions. These are usually targeted to global responsible investors. Ultimately, as an issuer or company who needs to raise capital, or as investors looking for new opportunities, the decision is very much yours to make based on your needs, values, outlook, and investment outcomes. That concludes this webinar. Thank you for tuning in. If you have any questions or feedback, do not hesitate to contact us. We will also be happy to share further reading and references. Thank you.